Good morning everyone and welcome to Morning Markets from True Potential. Today I wanted to focus in on some inflation data and the contrasts of that from Friday between the US and Europe, and also look to the week ahead. So if we look to the inflation readings from Friday from both the US and Europe, it's just interesting to note some of the trends that we can observe there. Particularly if we look at the US in the first instance, we got personal consumption expenditure, the price index there, and that's important to look at because we believe, and the market believes, that's the gauge that the Federal Reserve tend to look at most often when they're looking for an indication on inflation's trajectory. And what could we see there? Well, we saw that on the headline numbers we were increasing 0.3% month on month for May. But on a yearly basis, that's a rate of 4.6%, and that's down from where we were last month as well. But then if we look at the measures that include energy and sort of the more volatile elements, we could see really the impact of falling energy prices as well. And there we saw a decline coming through with the annual inflation rate running at 3.8% on this particular measure. And that's positive news, and it sort of serves to highlight that inflationary pressures in the US are certainly coming down quite materially. But it's just not probably at the speed policymakers have been expecting. If we then look at Europe and think about what we saw there, we saw European inflation at 5.5%. And this is the preliminary reading for June. That's down from 6.1% last month. Also then, if we look at that core level, around 5.4 as well. So I think that's the challenge. It's really highlighting that relative stickiness of inflation and very much speaks to the points that the ECB members speaking at the central bank conference were alluding to last week. The stickiness of inflation is likely to see interest rates continue to move up in the Eurozone. In contrast, in the US, we're probably much closer to that peak of interest rates. Also just worth reflecting, we've reached the halfway stage of the year on Friday. What did we see in terms of asset markets in general? A positive start to the year in terms of equity markets, most major equity markets up over the course of the year. Worth really mentioning the NASDAQ, that technology-led, more growth-oriented index in the US, an exceptionally strong start to the year, up over 30%. And indeed, looking back through the data this morning, I think we had to go back to 1983 to find a similar strength to the start of that market. So certainly something to observe. In terms of credit and sovereign bond markets, it's that ongoing story of inflation and interest rates, and saw some weakness in sovereign bonds over the course of the year, given that backdrop of rising interest rates. Just looking to the week ahead, probably a holiday shortened week. If we look to the US, we've got the 4th of July holiday tomorrow. I think key focus point in the US is obviously the first Friday of the month, that jobless claims report that we'll get for the month of June. That will certainly be very much in everyone's attention, just given the strength in the labour market and the strength in how that is supporting the consumption activity in the US. Other regions, a lot of survey evidence that we'll get in terms of PMI data points. Just looking this morning, PMI in China above 50, but really just above 50, so continues to illustrate the challenge there. In Japan, the Tankan manufacturing survey continues really to support that ongoing positive trajectory or momentum that sits around Japanese asset markets, but also the Japanese economy at this point in time. I'll leave it there for today, but please do join us over the course of the week. Many thanks.